silver naturally becomes that alternative. They'll see it at a much lower price per ounce and feel like, okay, silver has been rising as well, but I can get a lot more ounces per dollar for silver than I can for gold. I'm going to buy some silver.
Peter Krauth discusses how inflation is likely to be a significant feature for the next decade and the need for investors to seek strong alternatives. He argues that silver is undervalued and provides a proven hedge against inflation. Despite being a small market compared to gold, silver is essential to industry and has demonstrated its value over time.
I do feel that inflation is going to be a defining feature for the rest of this decade because there's really very little that can be done to end it. And I think wise investors need to look for alternatives, strong alternatives that have proven themselves over decades and even millennia. And silver is a perfect fit for that.
Peter Krauth goes deeper into why silver is a perfect hedge against inflation, especially when compared to other precious metals. He highlights how silver's price has remained below its 1980 high, making it cheap on an inflation-adjusted basis. The rise in gold and silver prices in the 1970s is also discussed, with silver performing significantly better.
If you look at how undervalued silver is, I think that's an important point to be made. If you look at the highs that were clocked by most metals, precious metals, platinum group metals, base metals in 1980. We're talking several decades ago, and when silver and gold both peaked. Silver remains the only one of all of those metals that is below its 1980 high. So silver is cheap on that basis. It's cheap on an inflationary adjusted price basis. And if you look at what happened in the 1970s, gold was up 14 times, so 1,400%, and silver was up 37 times, so 3,700%. And I think that we're in an environment that's similar to the 1970s. Not exact. I don't think history repeats exactly. It certainly rhymes.
Peter Krauth discusses the role of central banks in addressing inflation and why their ability to control it may be limited. He also argues that the debt-to-GDP ratio in the U.S. is much higher today than it was in the 1970s, making it unlikely that central banks can raise rates enough to combat inflation.
Some of the differences are that in the 1970s, the debt-to-GDP ratio in the U.S., for example, was about 35%. So much lower debt levels. Today, it's at 130%. So to think that central banks can raise rates enough to actually dent inflation, I think is pie in the sky. That simply will not happen. Inflation will run. People will have to get used to it. And it's unfortunate because if you look at what inflation does to your buying power, I think it's at 5.4% inflation over about 6 or 7 years, you lose 40% of your buying power. So $100 is worth $60 in about 6 or 7 years. And that's at 5.4%. So people really need to wake up to inflation, what it does to your investments. And if they don't want their retirement to be stolen by inflation, they need to look at proven hedges like silver that, as I say, have proven themselves over decades and even millennia. Silver is certainly used in a lot of applications. It's crucial to industry, and it has proven itself as money as an inflation hedge and value protection over years. But silver is a much smaller market than gold. And it being such a small market, it doesn't get the attention that gold gets. It's about a tenth the size of the gold market. If you look on a supply basis every year, gold being about, I think it's 270 billion, silver being worth about 27 billion annually. So silver being such a small market versus gold, it means that silver tends to be a lot more volatile. It actually does outpace gold's returns in bull markets. And so you definitely want exposure to silver. You may want to do so in a maybe more limited way because of its volatility, but the volatility should not be, in my view, something that any investor would want to use as a reason to not participate in silver investing.
Peter Krauth discusses the importance of silver ETFs and investing in silver. He highlights how silver ETFs took in a significant amount of silver in 2020 during the pandemic, and how there is very little selling that takes place in silver ETFs.
What happened in 2020 when we had the pandemic and people flocked to gold and silver as chaos hedges and uncertainty hedges, there was a lot of silver buying in both gold, but also ETF buying. And globally, silver ETFs actually took in about 330 million ounces of silver, which was about 4 times the previous year's level at about 83 million ounces. So that was really dramatic. It's very interesting how even after the silver price might have run up and then takes a dip, in some cases it might be a considerable pullback, there is very little selling that takes place in silver ETFs in terms of their silver holdings. So since 2006, when the first silver ETF came to be, the SLV, silver holdings in silver ETFs globally have climbed dramatically and have very rarely backed off, barely budge even when you get big sell-offs in the silver price. So people who buy silver through silver ETFs tend to actually hold on. So the ounces, the number of ounces, have stayed high and have continued to climb ever since the inception of the SLV.
Peter Krauth discusses how silver becomes an alternative to gold for investors who missed out on the opportunity to invest in gold. Silver's lower price per ounce and the ability to get more ounces per dollar make it an attractive investment option. The smaller market for silver also fuels its price up.
Silver being, again, a much smaller market than gold. If you look at what's taken place previously, is that gold gets most of the attention. It starts to build up. It's the better known hedge, so to speak. It's the go-to initially, at least. And so people often are late to the party. They'll see gold go up and continues to climb. Let's say gold, I'm not even going to make a prediction right now, several times, let's say higher even than it is currently. It's certain that it's going to attract a lot of attention. And if people see gold at multiple thousands of dollars per ounce, they're going to feel like they've missed that opportunity. They're going to look for alternatives. Silver naturally becomes that alternative. They'll see it at a much lower price per ounce and feel like, okay, silver has been rising as well, but I can get a lot more ounces per dollar for silver than I can for gold. I'm going to buy some silver. And it's a much smaller market, and that just feeds on itself and pushes silver up dramatically.
Peter Krauth explains how real rates can indicate whether gold is heading toward a positive price environment. Gold tends to move inversely to the real rate, and in 2018, when real rates started to fall, gold's price began to rise.
If you look at the best single indicator, at least that I know of, for whether gold is either heading towards or likely to be in and stay in a rallying or a positive price environment, is real rates. So that's essentially the rate of interest minus the inflation rate. And if you look at gold versus the real rate of return, gold tends to move inversely, very clearly inversely to the real rate. In 2018, real rates peaked and then started falling. That's when inflation started to rise, and we've been in a rising price environment for gold ever since. And interestingly, if you create the same chart of real rates versus silver, it's almost identical to the gold versus real rates chart. And so that, again, for me at least, is a very clear indicator as to where silver is heading. And I believe we're going to remain in a negative real rate environment for several more years. And that's a perfect setup for silver.
Peter Krauth discusses the fear of missing out, FOMO, as a silver peak indicator, citing the 1980 instance where people lined up to buy silver around the time it peaked. The gold-silver ratio and how to exit silver investments are also covered, with layering out the way to go.
I provide silver peak indicators. That's what I call them. And one of them is the fear of missing out. And so anecdotally, in 1980, you had people lining up for blocks to buy silver around the time that it peaked. And that was the month of January. So if you could imagine people lining up for blocks in the Northern Hemisphere in cold environment because they want silver that badly after it having run up so dramatically, that would certainly be something you'd want to look at. It's that party indicator. You've got the gold silver ratio. As I say, I think anything around, say, 30-1 silver to gold would be a time to start looking at a potential high in the silver price. And I also talk about how to exit. It doesn't have to be an all or nothing kind of thing. You can certainly look at layering out the way you could layer in when you buy a silver investment and start selling perhaps part of your silver portfolio in tranches and do that 25% at a time. If you're not completely convinced that we've reached a peak, you can do that. Perhaps you'll layer across that peak and you could still do exceptionally well. I think that ultimately we're going to head towards a reset of some kind in the global financial system. That's going to drive people back to real money being historically what we've seen, silver, gold in particular. These have proven themselves over millennia.
Peter Krauth talks about how silver and gold are real money with ideal characteristics, and how combining them with crypto would create a perfect crypto. The ease of use for transactions in crypto and the potential for a global financial system reset that would drive people back to real money are also mentioned.
If you think about it, physical silver, physical gold, they have no counterparty risk. They have no access risk. You don't have to worry about having the internet or electricity to access them. They are fungible. They are consistent. They're virtually indestructible, and they're private. They really have all of the ideal characteristics for what you'd want money to be. But I think you really can't deny the benefits of crypto. You have what we call frictionless transactions. In other words, very quick, seconds, fractions of a second, zero cost or near zero cost transactions. There's a lot of utility to that. You can transfer value in very little time. And so I think that ultimately, in my view, at least, the perfect kind of crypto would be a silver and or gold-backed crypto. And I think if a reset globally on a financial basis becomes bad enough, that you'd have people flocking back to silver and gold. But if you can combine that with crypto and then provide the ease of use for transactions, then you've got it made.